So Michael Correa, trade wars, it's sort of the hottest topic at the moment, all over the TV. What are you seeing in terms of your clients?
The sentiment really is wait and see. I'm not sure we really know what's going on in a real business sense. You know, a month ago we thought this was going to get resolved until we saw the Trump tweets come out, and then things changed overnight. And I think there's a degree of, well, we're not going to do anything until we know exactly what's going to happen. We saw that in our business sentiment survey that we released about a month ago, that on a short-term basis they're nervous, but on a long-term basis they're very certain that they want to be in China. You know, over 70% of our respondents said that over a 5-year period they want to invest more in China than they do today.
Trade war primarily at the moment is with US. So US is not a major Chinese steel export market. That's not going to have a huge impact for the steel industry.
Australia, I think, is a net beneficiary of those trade wars. It's interesting, Bain & Company do a biannual wealth report, and it scopes the size of the high net wealth market, but also gives us some indicators in terms of what markets high net wealth investors are looking to invest in outside China. Hong Kong is first, US is second, and Australia is third. I'm speculating the next time the survey is conducted that Australia will at least be number 2, having leapfrogged the US.
And do you think back home the removal of the election as an issue might be viewed positively by investors offshore?
I would think so. Look, one of the hallmarks, one of the key attractions of the Chinese high net wealth investor investing into Australia is a stable government and a stable regulatory system. And so I think with the election out of the way, that is good news and will deliver further confidence to our investor base.
So BJ, the iron ore price is running hot, above $100 a tonne again for the first time since 2014. Give us a feel for what customers and clients are saying on the ground in China.
Well, of course, this year you have some disruptions of supply. Nevertheless, steel demand for steel in China is still very, very strong. We are very confident in the Chinese economy. There's still a lot to do in terms of urbanization, in terms of really high quality industrialization. And then on top of it, China is promoting the Belt Road Initiative, which is very much infrastructure related. Property market, even this year so far, last year was very, very good. This year so far, still very strong. Even the big cities like Shanghai, Beijing, you have modern high rises. You don't have to walk very far away from the city center. You see the quality of 1950, 1960, 1970 buildings. Probably before long, they will be replaced by new buildings. So demand will continue.
We haven't noticed what I could call material change in flows, and as I said, it's a long-term view that we need to have. The traditional outbound opportunities is really in construction, and whether that be in infrastructure in China, but what I am seeing more of is actually ASEAN playing a bigger role in infrastructure. Australia's signed a free trade agreement with Indonesia. We've also done one with Hong Kong recently as well. So I do feel there's quite a lot of positive momentum for Australian businesses up in the region at the moment. And whether we see the natural resources boom as we're seeing it now play out the way we think it will, or we'll see other sectors come into play as well. One area which we're focusing very closely on is innovation and technology. And I look at what's going on in China and banking and let's call it the rise of the non-bank financial player. There are a lot of lessons Australia can learn from and a lot of technology we can apply.